Hey there, gang. It's Greg Britton, your Spokane mortgage strategist. I want to tell you about something that happened in a span of 72 hours that just really changed mortgage rates, mortgage pricing for a lot of people that were in the market shopping for a mortgage, whether it be to buy a home or refinance, and found themselves in a very short span of time that not the rules have changed, but the fees, the rates changed drastically in just 72 hours. In fact, it was the biggest change in a 72-hour period in almost 6 years. Okay, so significant. So let's look at what happened. And to do that, let's get a framework around kind of how this whole rate thing works. So you're a consumer, you go to a mortgage lender or a bank to get a loan. Okay, they lend you the money. Now that lender or that bank needs to replenish that money to be able to loan to someone else. They're really not interested in holding that loan because with as big of dollar amounts as mortgages are, they'd run out of money. Like literally the biggest banks in days, they'd be done. They would have no more money to lend. And so, they have to wait 30 years to get payments back. That doesn't work for them. So what they do is they sell the mortgages to what we call the secondary market, Fannie Mae, Freddie Mac, Ginnie Mae. You may have heard of these entities. I'm not going to go into the detail of how they came to be, but let's just say their job is to keep banks full of mortgage money to lend to us consumers. How do they do it? Well, they buy the mortgages that the banks own, because they've lent you the money, you've committed to pay. They sell that commitment to Fannie Mae and say, okay, we'll collect the payments, we'll service the loan, but we're going to give it all to you, and in turn you're going to buy it from us and give us more money to lend again. Okay, so for the consumer, really, you don't really know that they sold off your loan to Fannie or Freddie because you continue to pay the bank, but really the bank's just kind of a middleman at this point. Okay, they want to do more loans. They want the fees from doing the loans and need to keep doing more loans. So Fannie Mae buying the loans from the banks, keep the banks full of mortgage money. Okay, great. So now Fannie Mae has to get the money from somewhere, right? So what they do is when they buy all these loans, they bulk them together, and they end up selling them on Wall Street as fixed-rate bonds, mortgage bonds or mortgage coupons. And they'll have different ones. They'll have a 3% coupon, so that's one that pays a 3% fixed rate, 3.5%, 4%, 4.5%, 5%, 5.5%. Of course, you'll say, well, I'll take the one that pays 5 or 5.5%. Well, you can have it, but it's going to cost you. Okay, they all have different prices associated with them. The one we've been tracking most closely is the 3.5% coupon because that's the one that really correlates to the high 3, low 4 mortgage rates we've seen for so long. That's the bond that Fannie's selling that really is affecting consumer rates. So if we concentrate on the 3.5% bond, what we've seen for quite a while now is that bond's selling way past face value. It's really overvalued. Why? Because investors have a lot of fear about what was going on in the world and the problems in Europe and Greece and Portugal and our own economy, of course. And so fear drives money into safe investments, Fannie Mae investments backed by the U.S. government, considered extremely safe. And when there's fear, high fear, fixed rate, safe investments win. How do they win? They sell for very high prices. Keeps your rates as a consumer low on mortgages. Okay, well, the bubble kind of burst on this finally. That overinflated price went to a free fall March 12th, 13th, and 14th, a 72-hour period where it lost 200 basis points, or roughly 2% of its value. And you say, well, 2% doesn't sound too bad. Well, it's significant to the consumer, and this is how it works. So basically, let's say you were looking at a loan that Friday before this happened, and let's just use some numbers. Let's say you were going to get a $200,000 mortgage at 4%, and you had certain fees. Let's just call them X fees, okay? Now you come in Wednesday and you're going to commit to that. And the lender now says, well, the mortgage bond market fell apart, and you're all, what's that? And I'm like, the end result is that same 4% mortgage on that $200,000, the fees just went up 2% of the loan amount, or $4,000 in a matter of 72 hours. You want that same loan we talked about Friday? It's going to cost you another $4,000. Significant, of course. Or, you don't have the $4,000, you can take a 4.5% rate instead of the 4 that we talked about Friday, which is going to increase your payment about 5% every month for the life of the loan. So that could be significant, right? So huge turn of events. Now, why did the pricing on these bonds fall so quickly? It's a lot of the fear went away, and they've been overinflated for a while, and it just kind of was a mixture of positive economic reports, some positive things happening in Greece. A lower unemployment, better jobs creation, all these things that look like a growing and maybe an inflationary economy will kill the appetite for mortgage bonds. And it happened and there was a new stress test that came out that allowed some banks to dump assets because they found out they had more than they needed and that they were required to have. And so this fire sale on mortgage bonds, it just killed bond pricing, which resulted in what I just said, increased fees and or increased rate for the consumer. Could it bounce back? It could. Probably not as likely to go back as low as it was. Again, it was overinflated and the bubble kind of burst, and now it's going to come back more into reality. And wow, what a difference 72 hours can make. So I hope that brings some clarity, especially for you that were shopping that are told by your lender about this, and you're trying to digest how it just cost you this much money in this short period of time. That's what happened. Greg Brayton, your Spokane Mortgage Strategist, 509-999-9991. You can always call me if you have more questions. Have a great week.